Tonight, America at 250. We've become a nation of trillion-dollar companies. What does this mean for our economy? And what does it mean for smaller market participants like just billion-dollar companies? And the new Federal Reserve Chairman Kevin Warsh was brought in by Donald Trump to cut rates. Doesn't look like that's going to happen in 2026. What does that mean for our portfolios? And the Great Migration, leaving CG and GI, moving to MP and DS. These are not new programs, but they will be to some of you. It's Wednesday. That's Wednesday, July 8th. My name is Charles Brown. I'm your portfolio manager. We are from Chicago, and this is CB3 Live. We're We're so glad you're with us tonight. Hope you had a wonderful 4th of July. We had a very wet 4th of July here in Chicagoland, 4¼ inches in about 90 hours. Most of the fireworks across the city were canceled, but you could go home and watch them on TV, right? It's not quite the same, but we're glad you are with us. There's a lot going on in the markets. There always is, but tonight, maybe more than normal. The Great Migration, we're moving some investments around. It's important that you understand how this affects you. It's going to be seamless. So we'll get to that as we wrap up the show. But for now, we've got a lot of topics here. So the macro and geopolitical situation, I mentioned that earlier. America at 250 and the $1 trillion club. Economic data, we always review the June jobs information, unemployment, and Kevin Warsh's Fed. What does that mean for America? And then the Great Migration, which I mentioned earlier. We have a new word of the day. Protean, a readily taking on of different forms, endlessly versatile, able to become whatever the moment demands. I'm trying to be protean for your portfolios, the shape-shifting sea god of the Greek myth who could become water, fire, or beast, or slip away in any grasp. The truth is, markets adjust. We must adjust to the markets, and that is what we are doing in fairly significant way. I won't say dramatic, but significant way, and that is the primary topic of tonight. But before that, I want to get to the various issues that are pretty much causing this and have been causing this for several years and moving in this direction, but now it's definitive, and I'll explain as we go through this. So earnings season is just starting. 16 of 500 have reported, 88% beat rate. That's wonderful. But for 16 companies, nothing to get too surprised about. It's very good to see, though. Obviously, we hope this keeps up. We need strong earnings because that keeps PE multiples high and that keeps people buying. But again, 97% of the S&P 500 has yet to report. That'll be dramatically different at the August show on the 13th. So where are the beats coming from? Financials, industrials, technology, all 100% met or exceeded their projections. Consumer discretionary at 80%, staples at 75%, financials, not too many beats over here on the conservative sectors, and healthcare actually a big surprise to the downside, the lone real drag growth. But again, 97% of the index still has to report. We'll have a lot more on that next month. So what's going on in the macro and geopolitical space? The world's free market turns 50. We are the freest and most bountiful market in the world. And it is no accident that because we are the freest nation, we have the best free markets. 250 years ago, 13 colonies declared a radical idea: life, liberty, and the pursuit of happiness. And from that founding grew the deepest, freest capital market the world has ever known, and it continues to be. Remember this number on the right-hand side, $75 trillion. That's how much this market is worth. The entire U.S. market, the S&P, the NASDAQ, the Russell, the Vanguard, all of that combined is $75 trillion. What's really sobering about that is Elon Musk has 1% or $1 trillion of that, all right? So that $75 trillion is half of the entire global stock market value. The next 9 nations, it's larger than the next 9 nations together, and 65 to 70 of the top world companies are American made. No other nation has ever built anything like what we have built. And I'm emphasizing that because these terabyte, enormous trillion-dollar companies are what is driving the market, and it looks irreversible. Where we've tried to have somewhat of a balance in our programs, it's just getting more and more difficult to do that. Hence the reason that we have this great migration, which I'll get to in a little while. So how has America changed in these 250 years? So the median age in 1820 was 16 years old, which means people were dying in their 30s. Now the median age is 38. Fertility way, way down. We're just having smaller families. Foreign born, as you would expect, much, much higher, from 2 million in 1850 to 40 million. 46% ownership pre-depression, 65% today, but only 22% own their homes outright. Now, if you're not in that number, don't feel bad, because I'm not either. I paid off a home once, and it was right before the 2013 bull market, and I wish that money had been in the market. So I don't pay off homes anymore. That's just something for a different discussion. But for right now, don't feel bad if you are not in that group. Household size 7+ has dropped to 1 or 2 people. So the backdrop is older, smaller households and more diverse, more leveraged. The demographic reality every long portfolio has to plan around, and that's what we're doing. So it's really the American dream repriced, okay? 3 times your wages is what it cost to buy a home in 1790. Now it's 6.3. Actually, I would have thought it was higher than that, but that's the data that we're getting from the US Census Bureau. So the median home price, $403,000, annual wage about $64,000. Roughly doubled, okay, versus 1790. And again, I would have thought that was a little bit higher, but again, that's the data that we're seeing. All of this is leading somewhere, folks, and I just think this is data that you need to know to show you the growth in this country and how we got to be the $1 trillion era of investing. It happened in America. 16 companies are in the $1 trillion club. And I remember when the first one was. Anybody want to write in the chat who they think the first $1 trillion company was? Okay. Hey, Deb from South Dakota, how are you? Good to see you online. The Domagalskis visited us here just a few days ago. We had a wonderful time. We thought about all you guys and talked about this show. We welcome anyone who watches the show. Come to Chicago and meet with us. We'll have a splendid time. So of those, 12 are American. The biggest, of course, NVIDIA, $5 trillion. A little less than a year ago, it hit $5 trillion. And its newest member, SpaceX, of course, the largest U.S. IPO in history. We're going to talk a little bit about that coming up. On deck, OpenAI and Anthropic. This is not a bubble. This is the terrain of where we are investing now, and that's why DS is built to participate in this with discipline. All right, the $1 trillion republic, 12 of 16, I just mentioned that, but let's look at the companies: NVIDIA, Apple, Microsoft, Alphabet, Google, really, Microsoft, Amazon, Meta, Broadcom, used to be Avago, okay, that's the ticker symbol still, but Tesla, SpaceX, Berkshire, Eli Lilly, and Micron. I mean, is that amazing or what? Only 4 foreign companies, and that's either in the Middle East or in Asia, are larger than the companies that we have. It's just amazing. And this is what's driving the great migration that I'm talking to you about later on. So what's going on with AI? Well, Zuckerberg's super intelligence bet. This is a big time bet on the future of Meta, which, as you know, is a Magnificent Seven company, although they have not been so magnificent in 2026. So he is betting on this huge investment in this scale AI. All right. Meta's first close model, Muse Spark. All of these investments are what are called CapEx, or capital expenditures. 2026 CapEx at $135 billion, 2 times that of 2025, even as layoffs reach up to 20%. So why are they doing that in a time when they're laying off? Because if they don't, they will be hopelessly lost in the AI race, like another Mag 7 company. That would be Apple. Now, Apple has such an enormous hardware base that they are going to be able to weather this. But Meta does not have that hardware base. And in fact, most of their revenue, look at that, 98% is still from Facebook ads. Still from Facebook ads. So as far as the revenue generation, Meta has not successfully, they're a huge company, but it's coming from Facebook ads, all right? So their scale, they're in 14.3 billion, scale IA stake. Their stock is down 18%, 98% from ads. It's a pretty loud notice, I would say, to Mark Zuckerberg that you really got to pay attention to what you guys are doing. So this AI super cycle, $700 billion combined in the hyperscaler CapEx. That's Microsoft, Google, Amazon, Meta, Oracle. All right, these companies are going along with blinding speed. They are spending CapEx, and the markets are rewarding CapEx only with demand proof. Now, it's important that you understand that phrase. I'm going to go back and show you that again, but I want you to think about this phrase, demand proof, okay? What that means is you have to have demand for your product. You have to be able to prove that, okay? You have to be able to prove that, or we're not going to invest in you. And that's where some of the Mag 7 is struggling, okay? Some of the Mag 7 is struggling, not all of them, but it's just something to be aware of, okay? Another comment coming in, looks like yeah, okay, I just saw that came in about Meta. We have a child that works for Meta, and he had a comment on that. So, all right, guys, employment scenario, all right? Got questions? Type them in the chat as you always do. You're about 20, 25 seconds behind me. A lot of material to cover tonight, but I do want to answer your questions in real time if you have them, okay? So the hiring is cooling, all right? Not really what we want to see at all. So obviously with hiring cooling, it means we don't have an inflation heat on, but we do want to see jobs increasing, all right? 57,000 is positive. It's not negative. That'd be a recession if that continued for 2 quarters. But the reality is that they were expecting a much larger number than that. Unemployment rate at 4.2, wages growth 3.5, not too bad, but the participation rate at 61.5 is low. So not really the direction we want to see here. The squeeze is this, the wage growth, 3.5%, all right? We want to see more than that, still trailing about a 4.2% gain. Real earnings are under pressure. Wage gains are steady, not accelerating. And what that means is it becomes harder to live if inflation is increasing faster than your wages are. The participation rate means some people are still not finding jobs or just giving up and not trying. I don't really understand this because the participation rate didn't really go up to 70 or 80% during COVID when there were like 3 people for every job. Or that was just the opposite of that. 3 jobs for every person, okay? Now it's more equalized to a normal environment, but the reality is that we still want to see that participation rate higher. All this affects demands for goods and services. All of that affects the price of stocks into which you are investing. So this cooling jobs plus above target inflation suggests that stagflation, those 2 components together, squeeze the Fed, and it makes them have to navigate what they're going to do ahead. They can't be too hurried in reducing rates. Now, again, President Trump carefully vetted Kevin Warsh. I have to believe that he believes that Mr. Warsh is going to reduce rates probably sooner than Jay Powell would have done it. But so far, there's no indication that that's going to happen anytime soon. So where'd we get the job growth? Professional and business services, social assistance, healthcare, government. I don't really like seeing government having rate increase, but 8,000, no big deal. Manufacturing, 3,000. Leisure and hospitality took a big hit. People are traveling less. It's more costly. Fuel increases the cost to fly. We saw, but we don't have data on July 4th yet, but over Memorial Day weekend, which was May, overall travelers was down from the previous 3 years. So that's where the Fed's path is. Their next decision, July 28 and 29. The softer payrolls means that the Fed can at least pause here for a little bit, and the cooling labor market then buys the Fed patience on the inflation fight. Because there is cooling in the jobs market, at least the Fed won't raise rates. I mean, that would be awful, I think, especially after, again, Kevin Warsh just got put into office. Okay, U.S. policy. This is a pretty important story. And I haven't spoken that much about it, but here's the total, we talk about CapEx, right? Here's the investment in energy globally, $3.4 trillion. You're probably saying to yourself, gosh, that's not even as big as NVIDIA. Well, that just shows you how big these companies are, right? 3.4 trillion in energy, 2.2 of that in clean energy. That's why it's in green there. 2 times the amount of fossil investment. Now, I am not one of these that is anti-fossil. I think that we need fossil fuel in the transition. Obviously, anybody would want fuel that can solidly power during a cold snap in Texas, which the renewable energies did not do. But we are moving in that direction. And why are we doing that? Believe it or not, it's not just because people want to be green. It's because it makes sense, because it makes us safer. So what does this mean? Clean energy pulling away from the expenditures in fossil fuels. Look at the green. That's the number of expenditures in 2016 and forward in clean energy, and the gray is fossil fuels. You can see that starting in 2020, that starts to gain on clean energy, and it really takes off in 2026. So why is this so important? Because it's the single largest energy category ahead of total oil. And the reason that capital is chasing clean energy is for security. That means, and honestly, the Strait of Hormuz, even though it's not so important to us, but people are realizing that, you know what, there's just one body of water that one country controls, and they could put landmines in it and just shut down world commerce, or shut down 25 to 27% of world commerce. And we don't want that risk. So what do? You invest in clean energy, which any country can do. And it's for scale reasons and cost reasons. So I just think you need to know about this. We're always watching this space and looking for good opportunities in the clean energy space. So the tariff whipsaw, again, we're sticking with U.S. policy here. On Feb 20, the Supreme Court ruled that you cannot use the emergency powers, EEPA, all right, for tariffs. Well, the next day, the White House pivots and said, we're going to use Section 122 and have a 10% across the board import surcharge. Now, that's limited to 150 days, but they're already queued up with, look down below, Sections 301 and 232 to keep that tariff revenue virtually unchanged. So it's kind of in the small print. Even though the Supreme Court shoots down the administration, they're going to find a way to keep opening the tariff bucket and slapping these tariffs on not only our friends, but our foes, if they are dealing unfairly, in this administration's opinion, with the United States in regards to free trade. So the pattern, it's the same wall, new legal footing, and it just keeps coming back. So what are the deals that are done? The EU, 15%, Japan, China, dozens of bilateral. So the tendency during the previous administration, and frankly, the Obama administration, was for multilateral agreements with multiple nations. President Trump prefers bilateral agreements, which is just the U.S. and Canada, the U.S. and Mexico, the U.S. and Germany. All right. He thinks he has more control that way. And so far, that is proving to be the case. All right. The USMCA, which is the old NAFTA, was not renewed in current form. It's under current review. So all this is to say, what are the wild cards? All right. The pharmaceutical tariffs threatened as high as 200%. That's never going to happen, but that's what the threat is. 100% on countries that add digital service taxes on the U.S. I mean, it's just amazing, really, the clout that this administration has. So the headline is settling. The tail risk pharma digital taxes are where the surprises lie. I don't think that this is a major factor for the market performance, mainly because we were just at market highs a few days ago, obviously not today and the previous day. The Dow actually had a lifetime high earlier in this week. But the reality is that these tariffs are not stopping market performance, okay? What does this mean for your money? So the drag on tariffs is like a tax on imports, all right? The Tax Foundation pegs it as one of the biggest as a share of GDP since 1993, near $1,500 per household. But that does not take into consideration taxes where people are at a tax effect, I should say, where people are making a choice not to buy non-domestic goods and services. Now, I realize that there are an amazing amount of parts and supplies that come from overseas that get integrated into American-produced goods and services, but many are just pure imports, automobiles, chocolates, all kinds of things that come from other countries. And if we buy domestically, we are not subject to paying those tariffs, and neither are the companies, obviously, that are being tariffed, all right, by the federal government. So the administration is saying, look, we've got new market access from the trade deals. We have reshoring going on. Reshoring, very important word. I've talked about this on and off over the last 6 to 7 months. It's when a company comes back to the US that has been producing out of the country. A good one would be Apple. They're saying, you know what, we can't go straight from China to the US, but we can go via India, and then we can move a few things to Texas, and we're going to do more and more production in the US because we don't want these tariffs. And Trump is saying, we want the jobs. All right. So that's a good thing. I mean, whether you like the man or not, it's a good thing to see more jobs in America, and the dollar is stronger than it has been in many, many months because foreign countries are investing in the US and they're translating or transforming, whatever you want to call it, converting their currencies from their domestic currencies to the US currency. And that is strong for us. Inflation, always got to have at least a little section on this because it's a regular topic people ask me about. So we're back above 4%, but it's all an energy story. This is important. Usually energy and food are what drive the higher inflation costs. It's not so much food lately, it's energy. And in energy is because of the uncertainty in the war between Iran and the US. It used to be the Iran and US and Israel war, but really right now it's just Iran and the mullahs versus Trump. And that's what's making the energy costs move up and down. The mullahs are going to lose this. I mean, I think Trump is finally irritated enough that he's going to continue this until he gets what he wants. I don't know, but I do know that the markets are pretty much shrugging it off. Now, I came into the market today and they weren't. At 3 a.m. Central Time, the markets went straight down about 250 points in the Dow, and then a lot of that was recovered during the day session. So 4.2% is the headline story, all right? 2.9% is the core year over year, energy year over year. There it is, folks. That's it, all in one place. Natural gas up 41%, all right? The 2% Fed target still above that. The Fed wants to see 2%. Jay Powell never got to see 2% in the last 4 to 5 years. I don't know, but he ever got to see it when he was chairman of the Fed. So that's where Kevin Warsh wants it. That's where, everyone on the Fed, I think, wants it, but we're not there yet. So where is this heat coming from? Gasoline prices, fuel oil, airfares. And again, that's why we're not traveling as much right there. 27% up. Why? Because they have to get their costs reimbursed for flying. They just have to do it. There's no other way around it. Medical services, care, and shelter. Those are all increasing. What's cooling off? Core goods, used trucks, cars, new vehicles, medical care, commodities, and core CPI. That is good news. Again, usually energy and consumer goods and certainly food are what drive up energy costs, are what drive up inflation costs. So much to get my tongue straight on here, guys. All right. But for right now, it's only energy. It's only energy. The war, not tariffs, is what's doing the damage now. So you can take the tariffs out of it, guys. It's just not. So the Fed's read, it's going to be higher for longer. All right. The Fed looks through the energy spikes. It knows that eventually that's going to stop. All right. But the core creeping towards 3% keeps it cautious. So it doesn't raise rates, but it's not going to drop them. All right. No rate cuts in 2026 is what we're seeing on what we call the dot plot. And I've shown you that before. I'm not doing it tonight, but I've shown it to you. Warsh held his first FOMC meeting on June 17. The next decision, July 28, 29, likely another extended pause. All right. That's the big number to remember. 0 rate cuts for 2026. We will see what happens on the June CPI date, which is July 14, just 6 days from now, I should say. Core near 3% would cement the pause. If it's less than that, maybe not, but probably not. So I'm going to rest my voice for just a moment here. If you have questions, type them in the chat. Get a sip here. And then we will cover the Great Migration. Hey, John, welcome. Forecast memory back orders through 2029. I think that's accurate. And I know that guy, I forgot how you pronounce his name, Louis Navalier, is that right? Forecast memory order backlogs. And that's why NVIDIA is a $5 trillion company. And AVGO obviously Broadcom is doing great too. So, and Micron, we have all of those stocks in DS right now. Tax credits drive clean energy. Yeah, still. Those tax credits, I think you'll see as more and more, native investment in green energy increases, the tax credits will come down. But still complying with state-of-the-art construction deadlines and the tax credits, yeah, I get that. Those will drop off significantly. And I appreciate that John works in water, and he's an engineer, and he is very fluent in this area. I sort of feel insecure a little bit commenting on his comments because he really knows what he's talking about. We have really, really bright people watching our show, and very grateful for those comments, John. And you guys have any direct questions? If I'm talking, just ask John directly because he's definitely very much in tune with the energy space. So I'm calling this the Great Migration. Why? Well, for 16, 17 years and 9 years, we have had capital growth and growth in income. And we are now consolidating every client account into discretionary strategies and market proxy. So why are we doing this? Well, first of all, these are not new programs. One of them has been trading a year. The other's been trading almost 8 years. But there is so much overlap in the market, and I'm going to get into that in great detail right now. So the way this looks on a chart here is we're retiring CG and GI. Again, they've been with us since 2011 and 2016, I think. DS has been with us 7 years. MP is right at 1 year. And the reason for this is the overlap in market sector and market cap. So I want to get into that in great detail. There is nothing you need to do. If you have a concern about risk, if you're, for instance, a GI client might say, well, is MP going to be a lot riskier? There is an overlay, an options hedging overlay, which we introduced about 7 months ago. And I'll talk about that too. So just hang with me on this section, okay? So 2 programs under one household. DS is the aggressive, concentrated AI, Mag 7, and quantum growth sleeve of our portfolio offerings, all right? It's signal driven, exit discipline. We have I've talked about this before, our three channel signal. You can go back and watch last month's show or almost any show in the past 5-6 months, and you'll see that. And we do have the QQQ put hedge spread in there. It's hotter than the market by design, meaning most of the stocks in here are hotter than the S&P 500, and it's designed for long-term capital appreciation. Some people will say, well, I'm older and I don't think I really have a need for growth. Well, if you're 70 and you're hoping you're going to make it till 80, 85, you're going to need growth that's keeping up and exceeding inflation for those years. Now, when you get to 80, 85, you probably won't be in DS. You'll probably go back to MP, all right, or something more conservative. But for right now, the money that's in there should be not for money you're going to spend in the next 3 to 4 years, but money you're going to spend in the next 10 to 12 years, all right? All right, so MP, the market tracking core, we call it market proxy, all right? Broad, low cost, tracking the S&P at materially lower risk. So the mix of ETFs in here, this program is 100% ETFs, and its goal is to accurately track the S&P 500 and international exposure, okay? International exposure that never leaves. So in DS, we might have some international exposure from time to time, but if it hits our stop level, we're taking it out, all right? But in the ETF space, we are planning on keeping international exposure. But again, with the dollar so strong, we don't really need to have a lot of international exposure in MP right now. So it's a cap-weighted core with an equity income sleeve. That's all in there. We'll get into that in just a few minutes. And it has an optional SPY put spread cushion, no upside cap. All right. For those of you that are really conservative, you've had a lot of your money in GI and you're going, this looks too aggressive for me. The way to protect that's with the SPY put spread cushion. And I'll cover that just in a moment. So why are we retiring these? Both of these stock programs are mostly for individual stocks, and they were built for broad multi-sector participation and hedging. This was back in the day when all 11 sectors in the S&P 500, and there used to only be 10, all right? But the communication services got so large they had to break it out of the technology sector, and that became the 11th sector in the S&P 500. But as these companies have grown and grown and grown, they are just dwarfing the other companies in the S&P 500. I'm going to show you a chart on that in just a minute. All right. So by design, we were not investing in Magnificent Seven or trillion-dollar companies in CG because we had DS to do that. The challenge has been keeping CG on track to keep up with the indices when it, by mandate, has a limitation on what stocks can it hold. Okay, so in a market this top heavy, and we believe this is permanent, this change in the market is permanent, that structure simply can't keep pace. And the same thing applies to GI. This is a structural mismatch. And again, I believe it's a permanent one, not a bad stretch, not a broken signal. We know what those look like. We have times when we've lagged in CG and GI, and then we have a phenomenal 2020. We had a phenomenal 2024. But it's gone on now for a long enough period of time that we see that these two are just not going to be able to keep up with the trillion-dollar companies. So that's why we are retiring them. So the market has narrowed to a fewer names, and this is really important to understand. A very small group of mega cap stocks now drives the S&P 500 and the NASDAQ. Technology alone is 38.5% of the S&P 500 and 58%, one sector, just about 60%, okay, of the NASDAQ 100. The same names lead both indices, but in even heavier doses in the NASDAQ. So a diversified hedged book, which is what we had in CG for years since it began in 2011, and a mega cap led index now pull in opposite directions, and that's not helping you. So that's why we made this. And again, I'm stating that I believe this is a structural, permanent change. I could be mistaken. We may go back to where all 11 sectors actually matter and pull their equal weight. But just based on what John said about chip shortages, that's an indicator. You want to know where the market's going, look at SMH, which is the ETF for semiconductor stocks. We have quite a few semiconductor stocks in DS, and we also have just the QQQ index, which carries a lot of different stocks. So it's 100 different stocks, as a matter of fact, that are all technology focused. But the challenge is, how do you keep up with that when you have chip orders that look like they can't even be filled for 3 more years? And then when we get here 3 years from now, it probably will be the same thing again. So the market has narrowed. What does this mean? It means that the AI capital spending super cycle concentrated on earnings growth in a dozen platform and chip names has overtaken everything else in the market. Cap-weighted indices mechanically have to funnel more of every dollar into the biggest winners. That's what indices do. And passive flows amplify this loop. Call it a feedback loop. And the large grow larger by construction, not by choice, but because they have to. So breadth is when you have a lot of stocks participating in a rally, gets fewer and fewer names carrying the entire tape. The tape is the number of stock tickers up on the screen when you're seeing prices go across. That's the tape. When it used to be actual magnetic tape, but it's the reporting of all the gains and losses in a given day, in a given week, in a given month, in a given year. And that tape is getting narrower and narrower. Look at 2018, all right? 18% in 2021, 27%, the top 10 share of the S&P 500. 2024, 34%, 2026, 41%. You can do the math on this. By 2028, half of the market is going to be the top 10 companies. Remember that we also have SpaceX at approaching a little over 2 trillion now. It's gone back and forth because it's been pretty volatile since it started to trade, although it's calmed down. But Anthropic, which is Claude, and OpenAI, which is ChatGPT, will be IPOing at greater than 2 trillion, larger than SpaceX. Okay. So these companies together could be $7 trillion. You remember that number I pointed out to you to remember? $75 trillion. Three companies are almost 10% of that. I mean, it's staggering. So we have to adapt as a portfolio manager. We just do. So look at the left side. That's the leaders, the leading stocks, the S&P 500. And now here are the leading stocks in the NASDAQ on the right side. A lot of overlap there. NASDAQ, NVIDIA, Apple, Google, Microsoft. And then it varies under that. Sometimes it's a little easier to see this in a bar chart. So let's look at it this way. All right, NVIDIA, Apple, the S&P is blue, NASDAQ is orange or brown, whatever it looks like on your screen. But those huge, huge trillion-dollar companies just suck the life out of the stock market. And you have to be there. You have to be in them, okay? Except for Micron, which is mostly NASDAQ, all of these are pretty fairly represented in both indices. So what is discretionary strategies? Many of you have a DS account. We only made this available. It basically was kind of privately offered to individuals, not companies, for the first 5 years because it was really volatile. And then we found a way to tame it somewhat with the options hedging and a little more diversification and no margin. Okay. In the early days, we did allow margin trading on it, but we don't now. So the program is systematic and rules-based. It is still very much a growth engine. It still uses the CB3 three-channel signal system that I've talked about many, many times, but it's concentrated in the Magnificent Seven, the leading AI and quantum computing leaders, right? You're not going to find Procter & Gamble in here or Johnson & Johnson or Abbott Labs, not going to be in here. So signal-driven exit discipline plus the QQQ put spread, all right? That's the aggressive engine of what we're doing. So since 2017, in October, it'll be, 9 years, okay? 16 holdings, 88 on the nitrogen risk. Those of you that remember Riskalyze, Nitrogen is the company that took that over. And it's built basically with investors comfortable with volatility. But that would be all of you guys because all of you have a CG account. We don't have a single customer who doesn't have a CG account. And now you're going to have, you don't have to, obviously. We're going to get on the phone and we're going to have conversations. But for the people that know their risk, and we had dialogue, I've started moving people. We're going to have all of this done over the course of this month. So there's no rush. I still have CG and GI in my portfolio. I'm like the captain on the ship. I will not move my last accounts from CG and GI until every client has moved into their target allocation. I'm the last guy on the ship, and that's the way it is. I've always told you I trade what you trade, and I will do that to the last investor. But this is the prudent move for all of us going forward. So it's hotter than the market by design. Since inception, this program, and you can see this if you just go to CB3Financial.com and click on performance, all the full detailed reports are there, as well as, let me go back on camera here, as well as the migration plan for how we are moving from CG to DS and from GI to MP. So if you go there, CB3Financial.com, click performance, you can choose to download the 2 transition guides, we call them, as well as the performance on DS and MP and also SO for those of you that are following. That program is going to launch in October. We won't talk about that right now. So 427% since inception. That's not a double of the S&P, but it's close. All right, pretty strong return, 21% annualized, good Sharpe ratio. You can see the risk-adjusted numbers on the right-hand side and more data than this, of course, on the website printout that I just gave you. Okay, so what's inside the book, meaning what are we holding? So AI, semiconductors, 31%, mega cap platforms, that's going to be your Googles and obviously Amazon, Apple. Quantum computing, okay? Frontier growth, broad technology in QQQ, and then the hedge and cash. So we exited Palantir. I actually had one customer that ask, hey, should I keep my Palantir? And I said, well, you can in your own private trading, but we've exited it in CG and in DS. We also dropped Meta and Microsoft. Now, until recently, we always held a small portion of these Magnificent Seven companies, but these 2 companies are so bad. We did pick up a 10% weighting, sorry, in QQQ. which holds every Mag 7 stock at a large amount. And we just decided that that's going to need to be the representation for the Mag 7 stocks that are not performing well. Again, even with the Magnificent Seven, the performance is narrowing to fewer and fewer stocks. And if you're tracking your portfolio, as almost all of our clients do, versus the S&P 500, when we're lagging, it's because we're not highly enough invested in the highest producing stocks. Now, we don't want to just make your portfolios be 2 or 3 stocks. So I hope this narrowing does not exacerbate to the point where we've got to take yet another look at this. But right now we're very comfortable diversifying, not in 5 or 6 sectors, but in 3 themes. And that's Mag 7, AI, and quantum computing. All right. Again, 16 names in there. We call it the base core and then satellites. Yeah, 10% QQQ. New satellites, GEV, INTC, AVGO. We did add SpaceX. I'll explain why in just a little bit. BWXT. And some of you might say, hey, those are in my CG. Yeah, they are. We took the very best from CG and added them to DS and reduced the size of the satellites. So we have a little bit of diversity here. I mean, we want that for you guys, but at the same time, the biggest engines have to be those stocks that are heaviest weighted in the SPY, in the S&P 500 and the NASDAQ, okay? So the reason that we bought SpaceX so early, and people were saying, hey, I thought you always waited like 90 days. Well, the stock calmed down, all right? And that I took as a real good sign. In fact, frankly, because SpaceX calmed down and wasn't just trading like Tesla. Tesla's more volatile than SpaceX. It's crazy, huh? But Tesla has a lot of different irons in the fire. SpaceX basically just has SpaceLink. I mean, Starlink, I should say. So in case you're wondering who has the lead in satellites, it's just not even close. All right. UK, OneWeb, Amazon, China, Russia. I mean, it's just a rounding error. Everybody compared to Starlink. All right. 60% of all the active satellites, more than any other operator, every other operator combined, 10 million subscribers to their internet data service. All right. And it's really popular. Okay. So Bloomberg's take, Russia's Starlink rival is stumbling out of the gates. I mean, they're not even on the map, folks. So that's why we felt we needed to be in SpaceX soon. And why else? Because they're getting added to the NASDAQ. Well, why aren't they being added to the S&P? Well, because the S&P 500, I think, would love to have SpaceX, and they would bump almost anybody out of the S&P 500 because it can never be the S&P 501. Just so you know, this is not the Big 10, which is now the Big 19 or whatever it is. Football fans watching will correct me on that number, but no, there can only be 500 stocks in the S&P 500. And when Anthropic eventually and OpenAI join, they'll have to bump out 2 more companies. But the S&P 500 has a requirement that you have to show profits, I think, for 3 consecutive quarters. And SpaceX not really quite, I think it's 3 consecutive quarters. And then after you've done that, then you qualify. So the NASDAQ does not have that. So SpaceX joins the NASDAQ tomorrow or Monday or Tuesday. I'm not sure when, but we wanted to be there for that because we know that capital will come pouring into the NASDAQ. We believe that it will. It may not be on day one, but it will happen. Okay. So Orbit AI, the largest IPO ever, again, until OpenAI and Claude, right? It's just amazing. They just keep having, and you have to believe, I'm just got to go back on camera again. You got to believe that there are more companies out there that are going, well, looks like we got to come up with enough acquired companies we can add to our own company to make our IPO at least $2 trillion. I think you're going to not see certainly $100 million companies IPing anymore. If so, they're not even going to get mentioned in the news because they don't move the market. So the era of the $1 trillion IPO, multi-trillion dollar IPO is on us. All the more reason why you cannot beat an index unless you are in those players. You can't. You just can't do it. So inside this IPO, all right, 135, now trading about 156. I think it closed today. All right, peaked at 225. That was on day one. So Starlink, as I mentioned earlier, that's the profit engine. Grok, their AI entry is just burning cash, not doing anything. And their launch technology, that's the backbone, okay, Falcon 9, Starship, mostly flying Starlink satellites, okay? That's what they're in business to do because they can get paid to put satellites in space. All right, so it's a fundamental story. Their sales, 73 times, you're paying 73 times sales for Starlink and essentially SpaceX. And Meta's only 16x. All right. So you're really paying up for that, which is why we have only a 2% position in this, because we realize it could be a rocky ride. But eventually, if Musk's dream comes true of putting satellites in orbit around many planets in his lifetime, I mean, he's even talking about having 1 million people living on Mars before he stops breathing. He literally said that over the last month or so. So we need to be a part of a company that dreams that big. Maybe not a huge part, and certainly not in MP, but we need to be in DS in that, because you want to catch those huge winners, even if you have small positions. So, all right. So let's talk about market proxy. So as its name implies, we're basically trying to mark the profits and losses and gains and everything that goes with the actual S&P 500, but do it with less risk. So we're doing it calculatingly with 6 ETFs right now. We can go up to, I think, 12 is what we listed in our prospectus. I don't think we'll ever need that, but right now we have 6. We change their weights almost every month, and we did this month. You'll see what that looks like in just a few slides here. But it's built to track the broad market closely at a materially lower risk. That's what allows MP to be a good fit for GI investors. All right. So MP is the account of record for the GI investors. If you got questions, CB3 at CB3.com. You know our phone number, 312-513-7486. Give me a call. But that's why we're doing this. And we can put our SPY put spread sleeve, that's to protect on the downside, if you are a very conservative. We have 2 already that have asked me to do that on their MP account, which we gladly do. Okay. Nitrogen risk at 70%, which is under the risk of the market, which is between 76 and 77, does spin off a decent amount of income too. And so it's returned really pretty good here, 16% over a trailing year. All right. S&P at 1609. So basically, the same amount. During downturns, it tends to drop less. And you can look at the track record. Again, just go to CB3 Financial/performance and click on the MP fact sheet, and you'll see that performance right there. It's about 70% of the market volatility, very strong Sharpe ratio. 90% of its months have been positive. Okay. Just last month, S&P down 1.1%, market proxy up just a tiny bit. I mean, that's what we want to see. Lower beta, which means lower volatility. So you're not going to get rich in this program, but you more than likely are going to have very close to market performance at lower volatility. So really, that's why we're here with these 2 programs. For right now, unless something changes, and I've stated earlier in tonight's program that I think these changes are permanent as anything can be in the market. If we have chip orders that aren't going to be fulfilled for at least 3 years, and we have nothing but trillion-dollar companies, at least substantial nothing, coming to the market for IPOs, you got to be in that space. You just do. All right. And obviously, you're going to do some weighting changes. I mean, SpaceX could grow in weighting. We might open Anthropic at 1%. Don't know yet. Don't know what the data is going to be when it actually launches. But that's where we have to be. So ETFs make sense here. We have one for the broad market, one for large cap value. So those are stocks that are beaten down. But again, we can invest in this ETF anywhere, in energy, in healthcare, in consumer cyclicals, utilities, consumer staples, anywhere, international developed markets. Now, there are still great companies overseas in Asia and Europe. They're just small, all right? And they don't move the needle. And they are usually, well, almost always traded in the native currency. So if you're a German company, you're going to be denominated in euro. If you're a Tokyo-based company, you're going to be denominated in yen. And those currencies, the yen just hit a 35-year low versus the dollar. I think it was 2 weeks ago I saw it. It's crazy. All right. But we still want some exposure there. And then we have US small cap value. So these are small cap opportunities, 9%, again, diversified over like, I think, 150 different stocks, and a very small percentage of bonds. Now, if that's not enough bonds for you and you want that downside protection, we will put the option hedge on for you. Okay. On the right-hand side, you can see the changes we made this month. We are frequently changing the tilt, we call it, which is the balance. We might move the large cap holding from 36% up to 38, and then the next month down to 35, depending on what we see is trending in those different asset classes. Okay, that's how this program works. So the insurance that I mentioned, you insure your home, you insure your automobile, you can insure your portfolio. We've been doing this in CG, GI, and DS. We will continue to offer this in MP. Most people probably will not need this because you do have the QQQ protection in your DS account as you move from CG to DS. And we do have that component of bonds in MP, which will give you some downside protection. So it will soften a sharp decline. It'll reduce the depth of a drawdown. And again, we have a brochure on the website where you can see this. If you want to see more about it, or you want to talk specifically about it with me, just give me a call, shoot me an email. We'll set up a time and we'll talk. This is an opt-in on a per client basis. I'm guessing almost all of our clients are going to have MP accounts and almost all will have DS accounts. A few will just have MP, a few will just have DS, but most of you guys will have both. All right. And we can talk about whether the options hedging on both your programs makes sense. It's going to be on DS. It has to be because it's just too volatile. All right. And we've seen that pay off for us. So that's how they fit together. So concentrated upside from AI, Mag 7, and quantum, higher volatility, deeper drawdowns by design, but you saw the returns, 427% versus the S&P at just a little over half that. Okay, that's where the growth is meant to come from. MP, on the other hand, is broad market exposure, 70% of the risk, lower beta. Beta is the volatility of a portfolio versus the S&P 500. If the S&P has a perfect beta of 1, all right, so if your portfolio is 0.7, your 0.7 or 70% is volatile. If you happen to notice on the DS, it was 122, so it's 22% more volatile. That's where you pick up the opportunity for growth, okay? Most people, if you're drawing on income, you're not going to be drawing it from DS. You're going to be drawing it from MP. So the weighting of your portfolios is important. And I make it a point to talk to each of you that wants to talk about this. I know how I think you should be allocated, but if you have questions, I think my first appointment opening, I'm booked tomorrow, but I've got noon to, 5 o'clock on Friday if you want to talk about this. Okay. So again, most households will hold both, right? It just makes sense. Folks, that's it. That is the show. That's everything I wanted to talk to you about tonight. If you're new to the program, please click the little bell on YouTube, which will give you a notice every time that we go live. And also if I upload a program that is not live, but pre-recorded, and there may be some of those coming up, we continue to have new announcements and information for you guys. Follow me. I tweet every single day unless something happens, I get sick or whatever, but Facebook, X, and LinkedIn. And our next show, Thursday, August 13th. Thursday, August 13th. That's 5 weeks away. All right. So in between now and then, since it is 5 weeks, I will be doing my podcast. We've done these for a couple years now. We don't have a huge audience, but I do these audio updates usually weekly, sometimes every other weekly. If you have a topic you want discussed that's in between shows, especially these times when we're like 5 weeks between a show, let me know what that topic is and I will cover it on the podcast. Okay. So the word for today, rule number 1, most things will prove to be cyclical. Rule number two, some of the greatest opportunities for gain and loss come when other people forget rule number one. And it's for that reason we don't predict the cycle, we respond to the signal. Let me read that again. We don't predict the cycle, we respond to the signal. There's another way to put that. Another way to put that is, well, we don't have an ability to necessarily predict the market because our ability for which you pay us is our ability to most quickly respond and react and implement change for your portfolio to what's happening in the market. Our ability to react is far more important than our ability to predict. I always leave you with this from 2 Timothy 1:7. For we have not been given a spirit of fear, but a spirit of power, love, and a sound mind. And that helps us in times of uncertainty like we are going through right now. It must seem a little strange to you that our president seems like it just seems like they're making up the policy. I'm going to get in trouble with my friends on the right here, but just making up the policy as they go along with Iran. I don't know. But the market just seems to blow it off. Why? Because what are the most two important features of stock market returns? The Federal Reserve and their policy on interest rates and earnings. Are earnings good? Yes, they are. If we come back here in August on the 13th and that 88% beat rate, which we have right now, granted, it's only 17 stocks, but by then it'll be 250, 260. Okay, more than half. All right, if that's still at 88%, market's going to be at lifetime highs again, almost no matter what's happening with the war. So don't let it get you down. All right, we got you covered. We've got you covered on our monthly show, on our podcasts, and on my daily tweets. If you have questions, please give us a call. I think you're going to be excited to see a simplified program. Some of you have had all four accounts, all four SMAs, and there's been overlapping coverage. So now we have two very targeted, specific task programs that are built for the environment, the culture of a trillion-dollar company market. We thank you for watching. You guys mean the world to me. Thanks so much. Alice and I are just grateful you're here. Have a great continuing summer. We'll be back in August. We'll see you then.